fact that the more settled an issue is, the less interest there is in hearing about it. But since big data is such an unsettled and new topic, we're all very curious. So before we get started, I want to invite anyone who's in the back half of the room to come forward if you would like to participate in the voting. We will soon have, later in the session, we'll be using the voting devices. So I'm very happy to be here. This is my favorite new topic. My name is Kate McKee. I'm a senior advisor at CGAP, and I lead work on consumer protection and responsible digital finance. And I think this balancing act between protecting consumer data and the privacy and protection and security of their data and enabling and financial inclusion is perhaps going to be one of the most important balancing acts that policymakers and regulators are asked to try to accomplish in the next 5 years. As you'll see from our really interesting and diverse panel, that as Alfred reminded us, we're all very optimistic, and yet it's our job to also be a bit worried. So in this session, we'll be trying to balance the optimism with the worry. So let me first introduce our really great panel. Can you hear me all right? It's okay? Yeah, okay. Let me introduce our panel. We have, from my left around, Denise Diaz. Denise is a very experienced advisor, now working at the World Bank on financial inclusion and consumer protection. And she has been in and out of the Central Bank of Brazil over a number of years. Is that fair to say? Working on a range of topics, including branchless banking, market conduct, and many other areas. Next to Denise is Sue Lewis. Sue is a senior consumer protection and financial education expert, advisor, advocate, researcher, who's based in the UK, but has done quite a lot of work in emerging markets, including with AFI's Consumer Empowerment and Market Conduct Working Group. Next, we have Paul Breloff, and Paul leads a very exciting venture capital organization, fund, called, of course, my mind is going blank, the Axion Venture Lab. And this lab was set up to find investments to make that would promote financial inclusion and other development objectives. So he's now looking for entrepreneurs, including some of the ones who are in the room, who are using data and leveraging other resources in ways to make new commercial services possible. And last but not least, we have Armina Mukherjee, and I'm sure I did not pronounce that correctly, but Armina leads the market conduct function at the Central Bank of Armenia, and also is the leader of AFI's Consumer Empowerment and Market Conduct Working Group. So what we hope to do in the next few minutes is to explore a bit, what do we mean by this slippery concept of big data? Why are we excited about it in terms of its potential for financial inclusion? And we'll dig in a little bit on the actual business models that are emerging that are using new kinds of data in new ways to deliver services, financial services, to lower income consumers that were previously completely out of the system or had access to just a very limited range of services. Then we'll be looking at what are some of the worries that we have. So that's the optimistic part. Then we'll look at the concerns in terms of data privacy risks, data security risks, and other kinds of concerns that might be matters for regulation. We're going to push you through voting to let us know, so be thinking about this question. On balance, do you think that big data will be more supportive of financial inclusion, or is it more risky from a financial exclusion standpoint? So be thinking about that. That's the first question we're going to put to you. And at the end of our session, we'll be exploring what are some of the appropriate policy and regulatory responses. And if there are AFI members in the room that are already starting to work on this topic, it'd be really great if you participate with your examples and your questions. So I want to kick it off then. We will have the voting devices in a little while. Right now they're being used in another session. So this will have to be a show of hands, actually a show of bodies. So the question is, do you think that, okay, exactly right. With big data, will developments around big data ultimately lead more to financial inclusion or exclusion? So all of you who think that the answer is financial inclusion, can you please stand up? If you think that big data is more likely to lead to financial inclusion, go ahead and stand up. We want to see who's here. And you don't get the option of, I'm not sure, so I'm just going to sit here. Okay, sit down. How many of you, just to be clear here, how many of you think that there's more potential for financial exclusion from big data? Could you please stand? Okay. The rest of you, you will get an opportunity at the end of the session. We're going to ask that question again, and you will have to vote. So we'll see how we're doing there. Okay, let's get started then. What do we mean by big data? I'm sure that's part, at least for me, that's part of the reason I wanted to be involved in this session, is to hear how different people are considering the concept of big data. So we're going to put it first to Paul. Paul, you're going to start off by giving us a definition, and then the ladies are going to disagree with you about what's wrong with your definition, what else we think needs to be defined. Please.
Yeah, I think I am the official chief optimist on this panel, so prepared to play that role. Thanks, it's great to be here. Why are we talking about this? I think in some manner of speaking, data has been used in financial services for a long time. We've all done surveys. We've all had CRM systems keeping track of customers. What's really changing and what we're talking about when we're talking about big data are a few things. First, it's the volume of data being generated. As our lives have shifted to a digital landscape, as more and more of our interactions with the world are digital, and that includes things like digital financial services, but also our prolific now use of social media, more and more data is getting generated than ever before. If you think about all of the data that was generated in the history of time, until the year 2000, we are producing that much data every minute today. So the data out there is at a volume that we could never even imagine before. There's also a rich variety of data. It's not just a single stream along one dimension of behavior. There's now photos mixed with videos, mixed with numerical data, with written word. It's on all manner of topics, viewpoints, areas of life. Trying to make sense of that and relate between different data points is more complicated than ever. And the velocity of this data getting produced is happening continually. If you think of traditional credit bureaus that accept reports from trade lines or from financial institution providers once a month, we're now, as I said, generating the history of the world's data every minute of every day. So the volume, the variety, the velocity of this data is at a scale that we never imagined. What's also changed in the world is our ability to make sense of this with technology. It'd be hard to say that our computational and technology abilities have kept up with this explosion of data, but it's expanding very rapidly. And so we now have technology and advanced database tools that allow us to make sense of this data and make connections between this data in ways that were previously impossible. And so the combination of these new data, this explosive amount of data, and our ability to make sense of it has really presented some interesting opportunities and challenges for the delivery of financial services. Maybe I'll stop there just in terms of an overview of why we're interested.
So the definition that you're using encompasses the volume of data, the type of data, the velocity of data, and the use of technology for analytics and prediction.
And I would say that what's interesting to us is as we shift away, for a long time, we've used the same basic data endpoints to credit score and to assess fitness for financial services, marketing in financial services. I think that even broader than just this big data that we're referring to, all this digital data, is just the fact that there's now this alternate data, non-traditional data that is getting factored into decisions about whether to lend to people, decisions about what products are fit for people, decisions about who to market and what product to market to that person. I think that is what is different and what is worthy of more analysis and understanding.
And what's the distinction you're making then between alternate data and big data?
Sometimes there is alternate data that isn't particularly big. So utility payment histories, how you pay your cell phone bill, how you pay electricity bills. That has not traditionally actively factored into credit bureaus and credit scores, but it is something that could very well have credit relevance. So that's not big data. That's very binary. Yes, no, you paid. You can manage it with simple database tools. But I think for our conversation, probably useful to include in the mix of thinking about what implications this has for consumer protection.
So who wants to comment on additional points that might be helpful as concepts for this discussion? Denise?
Just comment on this. Yeah, I can see the difference, and the more I read about this big data thing and alternative data that might be personal data, but alternative to the traditional sources of data that financial institutions have been using for decades, the more confused I get, because even the publications only about big data, they start well with the differentiation, so large volumes, the 3 V's, no? Variety, volume, and velocity. Mm-hmm. But then when they started the discussions about consumer protection, that's when things become difficult to differentiate big data and the alternative data. And we can talk about this more. But I think the confusion is good for this discussion, so I wouldn't try to differentiate so much big data from other alternative data.
So you've added the concept of personal data as something we also, that often in the consumer protection space creates the sensitivity. Sue, did you have?
Is this working?
Yeah.
Yeah, okay, hi. Good morning. I think pretty much the same point, really. I mean, from a consumer protection perspective, the concern is about personal data and not necessarily all the other data. And sometimes data can be personal or not. So your mobile phone operator, for example, may know exactly where you are or determine exactly where you are. Well, is that personal data, or if it becomes anonymized? So there's a lot of issues even about the boundary of what is personal data and what is not personal data, which is even more confusing. But again, it's a discussion that I hope we can have. In a way, I'm not that concerned about the definition. It's about the uses of big, alternate, however you describe it, data, how it's used, abused, and therefore what regulators and governments should think to do about it.
But Armin, can you, when we think about financial inclusion, the point that is so typically made is about information asymmetries, and financial service providers don't have information on customers, which is why they can't, or on consumers, why they can't actually make it. Why are we talking about this in the financial inclusion space? And is there big data on lower income consumers that aren't currently served in the formal sector?
Basically, big data is around there, but for policymakers, one is the personal data protection. Until now, we traditionally do, and we think that those are just really personal things that you cannot find out of on the market, and this includes also, for example, mobile payments. These are personal data, and none of mobile operators has the right to disclose them to third parties. So from policy perspectives, these all information, whether they are under secrecy protection, under data protection regulation, or whether they are public available, they need to be analyzed and bring into new ways for policy decision makings to support financial inclusion. Because until now, data were seen as something to protect against any abuse or breaches, but not something that can be used to support financial inclusion policies. And we, as regulators, we are not much into, let's see how we can use, for example, for transparency, for better know your customer, or for better product design for low-income consumers. We never thought about to use all those data from different sources and channels to make policy decisions on that to support financial inclusion. Traditionally, we have been more on protecting, limiting, restricting use of data. And this is kind of mode until now.
And do you have that view on both commercial use of data and policy use of data? Your remark there was stressing policymakers can use data in a more proactive way.
For financial service providers is the same, but they are more in front of us because they use it whether we tell them or not, whether it's legal or not. Unless it's prohibited, it's allowed. With this principle, they use it for their marketing purposes, for their sales. There are challenges for them to collect data, to have an access to data. This is another issue, having the complex infrastructure for big data in general. But they are using this, and policymakers are behind them thinking how we can protect consumers, because sometimes, and very often, I would put, financial service providers are more profit-driven, rather financial inclusion policy-driven. And in this case, we can have a lot of risk out there. For example, they can use for discrimination purposes.
We're going to save the risk,
stop.
because we're going to be optimists first, and then we're going to be worriers. Okay, and so just definitions are always challenging to get through. I think the main point is that this is not really a settled terrain in terms of which definitions are being used for policy or commercial purposes. But Denise, late last night, 12:30 at night, sent a diagram to help us understand big data. And I wonder if we could bring it up on the screen right now. Maybe not. There we go. All your questions answered right here. So can you tell us the source of this?
Actually, it's down there, no? No, it's not there. It was a survey from Berkeley University, as far as I can remember, with, I think, around 40 industry representatives. So they are trying to define big data. And we can actually send the link later for each of the definitions. But these are the words that came out more often. But they are actually related to the three V's that Paul...
The variety, the volume, and the velocity.
Yes.
Yeah. Great. So let's turn more to the most relevant topic for financial inclusion, which is how are these large, varied, fast data being used in business models? And we're going to ask again, Paul, to kick off, because you have a vantage point where you see ideas, startups coming across the transom all the time. What excites you most from a financial inclusion standpoint?
Yeah, sure. I mean, we can talk about definitions a lot. Charts like this are interesting, but for me, almost more intimidating than useful. I think where this gets really interesting is when you think about the actual applications to helping expand financial services around the world. Why are we interested in this in the first place? We look out in the world, and there are billions of customers that do not have traditional credit data on them. You can call them thin file or no file, where they don't have traditional credit data. They don't have files in credit bureaus. They're unscorable. Unscorable customers cannot be lent to, and by and large are hard to serve. The hope is that if we incorporate data beyond the traditional data, which we can now get access to and make sense of given the technology available, that we can turn these unscorable potential customers into customers. And so as we look out in the world, it's a search for who has data and where can we access that data that we can turn into credit data to start, and so that we can say yes to more people. Starting simply with mobile phones, for example. This statistic is probably old, but at least a few years ago, the statistic I heard a lot was that there were 1.8 billion people on Earth that had a cell phone that did not have a bank account. If you think of those people as potential customers, if that cell phone data was somehow predictive of someone's ability to repay, you could turn overnight 1.8 billion unscorable people into customers of financial services if they were eligible and it showed that they were creditworthy. And if you think about it, data like how someone uses their cell phone can be very interesting and indicative of a behavioral profile of someone. So you can construct a lot of variables from how someone uses their cell phone, how many calls they make, from how many numbers, to how many numbers, do they text, do they purchase value-added services, how often do they recharge their phone, how consistently on which day of the week, for example, how many cell towers do they call from. All of these are constructed variables that could and are increasingly getting shown to have relevance to repayment capacity and ability to accept credit. So the hope is that if you look at people's cell records, Lendo is in the audience, and Lendo looks at, among other things, a customer's social graph. Looking at how they engage on social media and other areas. Jorge from Destacame is in the audience. He's organizing customers in a customer-centric way, or letting customers organize their utility bill payment history, cell phone payment history, and license that to banks to use when they're trying to assess whether that customer is a good customer or a bad customer. So there's a number of models out there. The promise is access, saying yes to more people, and hopefully with time, as we get a better assessment of actual true risk rather than perceived risks, this will lead to lower prices for customers. That is primarily in the credit realm that I'm talking, but we also hope that over time this will have more application in marketing and product design. I think where you're seeing the most excitement today is application to credit and credit assessment.
So you see why he's our chief optimist. Good sales job there. Denise, what would you add? And then we're going to go to Armina and Sue in terms of what excites you about potential for big data and financial inclusion.
I concur with Paul. For me, this is like the new generation of how do you think product suitability. It's like really exponentially enhancing product suitability. And it's not only from the regulator side, because that's regulators use that term, but it's actually from the business side. It does create new business opportunities, actually creates business value. So I would say I agree. It's beginning with credit, but the potential is enormous. And I'm actually not usually the optimistic one in the panel, but I'm very optimistic about this one. I think the potential to actually do a better client profiling by using those data, it allows you first to have more risk-based KYC requirements. It can turn unprofitable clients to profitable clients, even the existing ones. So you're going to have more competition within the existing clients in the banking sector and also in the non-banking sector. Adding this behavioral data that you didn't have before, it does allow you to really change the client profile and the segmentation that you have from your client base. So I'm really excited about that. And I'm excited about too on insurance side, not only for assessing the risk and getting better products there, but also improving the claims process. Because I think big data gives an opportunity of timing information. So what is the best timing for you to offer something, for you to have the claims process going on, for you to offer credit, for you to send a message to the client to tell them, save now when you're buying this. So if you know the lifestyle of those clients, you can actually really enhance the product offer. I would also mention the potential benefits for capability. When you use that data and you know more the client base, both by big data and other alternative data, you can do a lot more and be more effective on capability initiatives. And also from the regulatory side, I would say that regulators are way behind. So they're not only behind, they're way behind. They're years behind. I would say that most of them do not understand what big data is and the potentials for regulatory enforcement and also understanding of the market.
Sue and Armina, what would you want to add? Sue, please. Take
Yeah,
your microphone.
yes, I agree with the last point. I think for me, the exciting potential here is for consumers to own their own data and have control over their own data. So maybe they have like a little electronic folder with all the things that, all the data from everywhere. So that's their profile, but they own it and they can choose who to share it with. They can move it from one provider to another. So it gives them some control. Another interesting thing is, I think, the point Denise raised, which is it gives the potential for consumers to find out things about themselves. Where do they stand in relation to spending habits of people like them, for example, or savings habits of people like them? And then you can draw them into things like saving and budgeting. So there's all sorts of personal benefits I can see there for consumers. I'm going to be pessimistic in a minute, but I'm being optimistic right now.
Right. We're going to actually turn to the audience where we have a couple of entrepreneurs that are using data heavily and new models in their businesses, and you each get a 30-second infomercial on how you're using data. And can I just see, is there anyone else in the room who wants to speak on this? These are actually businesses that are using data in these positive ways for financial inclusion. Okay, well, they're all sitting here together.
Hi, thank you very much. My name is Jorge Camus. I'm the co-founder of Destácame. And what you said, Sue, I think that is really important. And I think that that's where the world should go in terms of each person owning his own data. I think that technology enables that now with access to mobile phone, smartphones, and internet. That now can be created. Actually, Destácame, my company, I don't want to be an infomercial, but we're trying to do that, actually. So we're creating a platform where people voluntarily sign in the platform and give us the consent to pull out their data from the utility companies, and we show them in the platform in a private profile. And then it's the person who owns the data who sends out the data to, for example, banks. So all of the data protection problems are solved because the data is managed by the person. And we think that that's a big game changer because everybody is scared about what's going to happen with my data. It's all around, but you never know what's happening. So what if you can control your data and create an asset that you can then profit it? Because, for example, if I'm not in a banking system, but if I'm a good payer, I want to show that to the banks. And of course, I don't have the opportunity using my financial information because I don't have, but I can use my utility companies.
Do you want to add?
I think it's very important for banks the use of alternative and big data, and I also want to raise one point. There's a topic of cloud computing. No? Cloud computing is very important in order to decrease the cost of the analysis of those big databases that we are creating for analyzing and improving the user experience of our clients. And with regulators, there is also a very important topic because there is a huge fear among regulators about how the cloud computing will be used and where are the servers that banks are using for processing those data. Then that's a topic that it has to be discussed with regulators and a better understanding of how banks are doing this or want to do this because in some cases it's prohibited.
Okay, so Carlos chose to use, this is Carlos from BBVA, he used his infomercial to make a pitch to the regulators in the room about the topic of cloud computing and data security. So let's move now then to the risks. And Armin, you are going to start off. What we've heard, this is pretty exciting. We have products that previously couldn't be written to customers. We have potential for better tailoring of services, for better communication, financial capability, financial empowerment. This is the end of the happy chapter of our story. Let's take a look at some of the risks that concern you as a regulator and policymaker.
After Paul's example, I remembered we have a complaint in Armenia. A few persons complaining that one of the banks rejected the loan, although their credit history was perfect enough, like beforehand. And the reason was that our credit bureau includes also other type of information like utility payments, this alternative data, and one of the banks make that scoring. And they find out that some people are better for their bank than the others. And those who has no that kind of active behavior in buying all these applications and all other stuffs, or paying too much utility payments because they are saving energy or this kind of thing, they found, or TV and other data, they found that they need some particular very consumerist type of consumers who pay more. So the discrimination is one of the issues. From a financial service provider's perspective, it's all good because the first point is profit. But from government perspective, we need to think about inclusiveness, those not allowing discrimination. Other types of discrimination can be based on gender, on ethnicity, and this can always happen if they very quickly find out who is who out there and can grab them.
So I just want to pause. All right, so risk question number one is when we look at the use of data, scoring, profiling, what is it? It's attempting to discriminate between consumers that you want and those that you don't. And so you're raising the potential that these criteria might not actually be fair, or they might not be predictive of the behavior of the customer, the segment they've been classified in. Okay, that's risk number one. I'll let you do one more, and then we'll let others take a stab at that. What's your second preoccupation?
Well, I put the one that probably the others will not. Another one is, in general, macro and in macro level, is the competition. Those companies who get access to those data, they can quickly be aggressive in rivalry and get market power. This is, in long term, this is not an issue because you can solve it. But in short term, it can bring to less competition. And from a state perspective, from government perspective, this is something to think about it. Because if you do not regulate the access to data properly, so there is discrimination or not level playing field between financial service providers, and this can lead to unfair competition and instability in the market over long term.
So let me just bring that out. So hypothetically, we could think of a country that's a leader in digital finance and that has a very dominant provider, that previously the advantage they had was their infrastructure and first mover on the products, and now they have an additional, if you will, asset on their balance sheet of customer data. And so they are in a position to continue that domination into additional services. Is that the point you're raising? And I guess especially then this question of, can customers take, as Jorge was reminding us, can customers take their positive credit history, for example, elsewhere? Or are they tied in some way to that dominant producer? So it could have both demand and supply side implications.
Yes, and another one is irresponsible marketing, which financial service providers can use and which can bring to misleading information and not aware decision making by the consumers. I remember we have an expert on big data in Armenia, and back he says, you know what we can do, and it's an example from sales, from just sales of food. And I said, we got to a woman and suggested her pregnancy items to be sold, and she didn't know that she is pregnant. But they were monitoring her behavior in the shop, and they found that she is pregnant earlier than she found herself. So decision making at what choice you are doing when it's not responsibly marketed can be, on the demand side, they can be misuse of the product that beforehand they have never even thought about. It can be, until now we're also trying to regulate misleading marketing, transparency and disclosure practices, but it will be even tougher to find these subtle tricks that FSPs use to reach out consumers and to sell more products.
Mm-hmm. Great. Okay, you've got 3 issues for us to think about. Denise, what would you want to add? Since you're usually, now you get to be the pessimist you're more comfortable with.
Actually, I was going to comment, we talked about this earlier, and Paul had the same point, but the thing is, these things already happened before. Irresponsible marketing, discrimination, these are long-standing issues. Maybe now the difference is that these long-standing issues and discrimination and bad practices, they are just easier. And because of the velocity and the wealth of not only range of information sources, but also the speed with which you can get access to that information. I'll actually add the risk of inaccurate profiling and what is the role of these institutions, these companies that are doing these algorithms, and are they good or are they not good, and how much can we trust them, and what is should the regulator look at them too? I'm not sure. So I'm really afraid of actually not the use of the data itself, but people trusting too much the analytics on the data.
Mm-hmm. Mm-hmm. Sue, would you add to the list of risks?
Yes, on that point particularly, I'm very concerned about the use of personality questionnaires because of their cultural bias and because all these things are just assessing risk. They don't give the lender certainty, and actually people get into debt most often because of a change in circumstance after they borrow the money. So they lose their job, they maybe divorce, and that's what gets them into trouble. And there's no way of determining ex ante. Well, you might be able to look at the probability of divorce, I guess, but there's no way of determining ex ante whether those things are going to happen or not. So I do think these profiles have to be used with extreme caution. I really do, because they risk excluding, discriminating as well. There's some very obvious things, of course, that have been around for ages: fraud, identity, theft, and those in terms of protection are kind of what I think of as non-tradables. You know, those things have to be got right. But then there
May I just add on that? So I actually would have expected that the data security, and asking those of you in the room, I had expected a conversation to focus more on data security and a little less on privacy. So we can come back to that perhaps in the question and answer session. And when I think about Carlos, your observation on cloud, you know, all this data sitting on the servers, who knows who's watching the data, who knows who has the potential to hack into it. I think that's as more a data security issue perhaps than a data privacy one. But you're drawing the connection then between what data we're sort of giving up and opening ourselves up to identity theft and fraud. Okay.
Yes, but I think some privacy, I think security is kind of non-tradable, But privacy is sort of tradable, and by that I mean consumers may choose to give up information about themselves in order to get something in return, and it may be the loan or it may be a different kind of financial product. So I think those are two very different risks, and actually the privacy one is probably a little more interesting.
And thornier.
A bit thought.
Paul, I want to ask you. Oh, you get one more then.
Okay.
Just so we don't get too depressed here.
Sorry to be depressing, but I do think this better risk assessment can lead to different types of exclusion. I mean, we have to remember that although most people have a mobile phone, not everybody does. So these kinds of products and data gathering are not accessible to them. They may find that the questionnaire they have to fill in is not in their native language. And these are kind of familiar exclusion problems, but I think they affect probably different people under, the big data scenario, migrants, etc. And the half point is regulators are so far behind, and that is really scary.
All right, we're going to turn to regulators in just a minute and then open it up for some discussion. But Paul, I wanted to put you on the spot. So you're clearly an optimist. You see business models you like. You're putting your money and your reputation into them. Are there a few tough questions you try to ask to really understand whether the data policies and handling are adequate?
Yeah, I think these are all very good points, and I think with any time a new technology enters the scene, there's a lot of promise, there's a lot of risk, and a lot of new issues, and I think these are all very good ones, and all ones we consider when we look at businesses. On the potential for discrimination or this leading to exclusion more than inclusion, I think you've got to look today to how this is actually getting used. Right now, most firms that are making use of big data are using it to either lower the cost of serving these customers or to be able to say yes to people they haven't been able to say yes to so far, to increase their acceptance rates. Because if you think about the economics of lending, once you've got customers into your funnel, you want to be able to say yes to as many as you can safely say yes to. That's how you make more money. And this is a tool that could lead to more yeses. Very few people are using it to try to make it easier to say no. The other is to make it cheaper, particularly around boring areas like ID or employment verification. So we mentioned the risk of fraud. Preventing fraud for financial institutions is very expensive. Confirming that the person is who they say they are, that they work where they say they do or live where they say they do, that is very expensive. If big data, by cross-referencing databases in a split second, is able to bring that cost down to pennies or reduce the reliance on lots and lots of forms, which are terrible and annoying for customers and difficult for institutions, I think that's a good thing. The marketing question, I think, is a very good one and one we look at. How is this going to be used, particularly as we look at this new world of personal financial management tools, whose business model might depend on collecting a lot of customer information and then monetizing that by selling these as leads, as customer leads to banks. That is certainly something that scares me a little bit, I think should be monitored. I do want to emphasize, though, the flip side to this, that technology, more and more, the digitization of our lives often leads to, I think, a decentralization of power and an empowerment of customers. It's a balancing act, but I would argue probably more so than the risk of getting misled. I think we now have tools at our disposal because of internet, because of comparison web portals, because of personal financial management tools, as Sue mentioned, that are able to compare you to other customers and make active references or ideas or recommendations about how you could improve your credit profile or improve your financial behaviors. To me, there is a risk of getting bad products marketed to you. There's also this empowerment dimension. The last thing I'll say.
All right, and you have 10 seconds.
Yeah, 10 seconds, and I'm going to say this probably 5 more times if I get to speak for it 5 more times. Many of these problems are significantly mitigated if the customer owns that data and the customer is deciding who to give it to. And the regimes where we have today gatekeepers who sit on some of the most valuable data that could be used really puts the power in the big corporate and financial institution and mobile operator hands and lessens the power of a customer to take control of their own destiny. So if we think about a lot of this, discrimination, anti-competition, even data security to extent, I think that's a part of it. I'll stop there.
Okay, Denise wanted to make a comment, maybe using Sue's mic, and I wanted to see if there was anyone in the room who had an additional risk that really hasn't come up yet. Sorry. That you would like to raise. Yeah. So Denise, make your comment, and then we'll hear from Ali.
Yeah,
and then we're going to vote.
Sorry, I have a comment about the alternative data. And by collecting the alternative data to the consumers and scoring this data, you are managing the over-indebtedness risk, the major credit risk in the country. By managing the over-indebtedness risk, in this case, you are protecting in macro level the credit, the economic sectors in the country, which is not under the umbrella of the supervisory authority. It means that collecting alternative data is very essential for protecting the consumers and protecting the other economic sectors in the country. Thank you.
So this raises, it's the flip side. It raised the over-indebtedness concern and then also the opportunity for the regulator to actually use new data to see what's going on in the market. Denise, last comment on this, and then let's pull up the voting question, since I understand we have the technologies in the room now.
I just want to emphasize two of the points that Sue and Paul made. First is Sue's point about that consumers are willing to give up some privacy to have access to better services and access to services that they didn't have before. And actually there is some research there for EU consumers. And I would imagine that consumers in developing countries, the ones that have less access, they would be more willing to give up some privacy. But then there is the question of how do you make that question? Because now with big data, some data, they do not look like something that is personal when it's created, the data is created. So it might not even look like financial information and then becomes a tool for financial decisions. The other point is actually the point of market power of those controllers of the data. Actually, I think this is one of the key and really major points for people to think about, because we should not allow big players to have control of the data. And I really like the idea that was raised here, and Paul said the other day, of consumers having that power to manage their data and give access to a range of players for them to use their data. But then again, I think the challenge is how do you qualify that data? It's very difficult on a big data era.
Right, okay, so we're drawn to the concept of consumers owning their data instead of telcos and banks debating who owns the customer, if it could be made realistic. And we're drawn to the idea of individual control of data, or really in Chile, it's almost like a custodian that's helping people manage their data footprint. But the how of it, particularly in the inclusion space, is quite challenging. Sue, you're making a remark, and then I need you to pull up, please, the voting question.
Well, sorry, I just wanted to give a quick example of this point Denise made about data that starts off not looking personal. It relates to this point too. So I shop in the supermarket every day, I use my card, I buy cigarettes, I buy alcohol, I buy a lot of sugary stuff, and then that data gets sold to an insurance company who will make me a higher price for my insurance because it means I'm less, these are risk factors for living not so long. But I didn't agree for that data to be used in that way. Now, you can argue whether that's a fair use of data or not, because it's absolutely true. I am less likely to live longer if I do all these things. But is it fair that data is used without my knowing? That's the example.
Okay, so informed consent, which tends to be everybody can agree on informed consent, actually extremely tricky to achieve. Because can you really consent to future uses of your data that you're not aware of? So can we have, please, the polling question up? Not the first one. Keep going. Please, no voting. Next question, please. Okay, we wanted to turn the floor to you. So let's do a quick vote here, and then we're going to take comments and questions from the floor, and then we'll wrap up from our panel with their observations on what they think you should be doing on this topic. So please keep voting. Does the regulator have a role to play, really, at this point in time, in dealing with the different risks from big data and alternative data, given all the potential benefits that we've heard for financial inclusion? And we'll stop when we get to 50 votes. Okay, let's see. All right. So yes, and not just monitoring, but regulation. So our question to you, and we're going to turn the floor now over, is do you have the authority? Do you have the information? Do you know what you want to do? Or maybe are you already doing some things that are relevant in this space? So let's see hands then for who would like to make comments or ask questions on the topic. We're going to do this for about 10, 12 minutes and then get a lightning round of views from the panel. Anyone feeling brave about making a comment? Since 71% of you think you should be acting. Yes? Or question? Please, Musa.
Thank you. My name is Musa Kamara from Central Bank of Liberia. In the case of Liberia, we have a very stringent confidentiality law, which requires that the customer will have to consent to whatever information that a third party, a second or third party, will have to use about them. But the law also, the New Financial Institutions Act, does give the central bank the mandate or the authority to investigate specific information about individuals that raises issues of legal questions, regulatory issues as well. But those, again, in that case, you will have to seek court permission to be able to do that. So I think from all of these conversations, the legal framework is very critical, because at least that will be able to define exactly what sort of individual information people can access and what sort people cannot access. So I think the legal framework, in my mind, may be something that needs to be considered seriously. And speaking in the context of financial inclusion, I think this is very critical, because if we want to bring more people into the formal financial system, of course, data matters. But then the question again would be, what sort of data that should be accessible or available?
And with what kinds of safeguards? So do you feel you have an adequate legal framework to deal with whichever of these risks are relevant in Liberia? Short response.
Well, I have to say firstly that Liberia as a country is going through a lot of reforms in our legal and regulatory system. And all of these questions have really been addressed. For instance, we are now in the process of developing our credit reference system. And of course, there are questions of how much information should be accessed on individuals. We also developed a collateral registry system, and those questions also came up. So I can say that at this point, it may be difficult for me to say whether we have an adequate legal framework, but I think we are in the process of enhancing our legal system to see how we can balance, the issue of confidentiality versus issue of inclusion.
Great. So you mentioned Bank Secrecy Act, Credit Information Bureau, Collateral Registry. All of these might have relevant provisions. Whether it is adequate is not entirely clear in your mind. Other comments? Questions? Yes, please. And then I'm giving a warning to Deputy Governor Espinilla. Mr., I would like you to comment on this as well. Here and then
Merci. Je pense que, en général, le dispositif existe, le cadre légal est bien écrit au niveau de l'ensemble presque des pays. Maintenant, ce qui pose problème, c'est surtout l'application, le suivi. Est-ce qui doit veiller à l'application de la réglementation? Parce que la loi statistique qui est là, c'est qui doit veiller à l'application de la loi statistique au niveau du secret bancaire? Donc, à qui on doit s'adresser s'il y a violation. Mais d'une façon générale, on voit que tout est écrit. Mais comment le suivre, comment veiller à ce que ça soit bien appliqué par celui qui collecte l'information du point de vue du régulateur, parce que, ayant besoin d'informations, le régulateur fait de la collecte, l'institution financière aussi fait de la collecte. Maintenant, pour tous ces collecteurs, qui doit faire le suivi? Comment ça doit être vraiment appliqué la loi? C'est ça qui pose problème en général.
So very important point that it's one thing to have laws and even regulation, but is there enforcement? Is there capacity? Is there the ability to gather the information that you need to make these judgments on data privacy and data security adequacy? Deputy Governor Espinilla, did you want to comment from the Filipino vantage point? That was actually a rhetorical question. You may not have wanted to comment, but I'm inviting you to.
Thank you, Kate. From our perspective, we're looking at this issue of big data as in a cautiously optimistic manner, because I think clearly, because credit is an information business, and you need information to be able to do credit prudently, and also there's the real opportunity to lower credit costs and open access to others who had previously not had access because of lack of data. So that, I think, could not be ignored. But I think the issues that were also raised regarding risk are quite real, and therefore we're approaching it with an open mind, but also seeing a role for regulation here. If you ask, do we have the legal framework to regulate? I think as a bank regulator, we have conduct authority, and we can certainly influence the behavior of service providers in the manner that they use data, whether it is to provide credit or to even establish identity, which is, or verify identity, which is another potentially interesting usage of big data. So there is a way to engage this and manage some of the risks. But clearly, I like the idea of putting in place some kind of a data governance mechanism, perhaps captured in a law, wherein the idea that the data is owned by customers and has the ability to decide how the data is to be used. I think that's a very important principle to hard code in law if it doesn't exist. Thank you.
And I want to actually invite, thank you so much. I want to invite Jorge again. We were talking beforehand about the Madrid Protocol. Maybe you could briefly describe what that is, because it speaks directly to the Deputy Governor's point on data governance.
Yes, in terms of regulation, we think that it's really important that the legal framework address the issue that the data is owned by the person, and when the person takes control of data, many problems are solved. So have a legal framework that protects that. I think that's a key issue to address all of this problem. And in terms of that, the Madrid Protocol signed in 2011 in Madrid. It's a very good sign on that, and it's the legal framework that many countries in the European region and Latin America are using. Mexico, Peru, I guess, already implemented, and Chile, for example, are going in that direction. That includes an office that overlook all the data, so overlook all the data database managers to fulfill the law. So yeah, I think that in summary, it's important to protect the customers in terms of being the owner of data.
Great. So I want to ask Denise and Armina to, as the regulators on our, or former regulators on our panel, to make their final comments, and you'll each get a little bit more time, and then we'll hear from Paul and Sue for parting observations here, and then we're going to do 2 more quick voting questions and wrap up. Denise.
So just not to be too optimistic always, I like to talk about the devil is in the details of the regulation. So we, in the World Bank, we have an upcoming publication about regulation and big data, and it's becoming clear that the current standards that are very useful for traditional data, they become really tricky, and we talked a little bit about that already. But let me just quickly give you a flavor of that, and that is related to the fact that mostly it's the 3 V's of big data, but also the disconnect between the purpose of the data when it's disclosed, when it's put out there. For example, when you put a post in Facebook, you had some purpose, and then the purpose when people are using that data, that's completely different. So many of the challenges in regulation, on the details of the regulation, come from this characteristic. So let me just mention them. One is defining the data controller. Who controls the data? Who controls the data if it's about your emails, about your Facebook posts, your Twitter posts? Are you the controller, or is somebody else the controller? Second, what is personal data? And we mentioned this, the really difficulty in defining personal data in a big data environment. Third, consent, when the data is issued for one purpose, but then is using for another purpose that you might not be aware of. And even the people who might be collecting might not be exactly sure of the purpose of the use of the data. Third, it's actually fourth, the security measures that are traditionally used in data security regulations might become way more complex with the number of companies and parties related to collection and use and analysis of the data. And finally, the access and correction rights, which are usually in the data privacy rules, some of them actually become meaningless in a big data world. So we are investigating this, and hopefully the publication will be out soon.
Can I ask you while you have the mic, what is your 1-sentence piece of advice to the people in the room on this topic?
Since most of them are regulators, I would say learn first. Do not jump into regulation because it's going to be difficult, so try to learn what is happening in the market.
Armina, you get your advice to regulators in a little bit fuller sense. Yeah.
Yes, in many sense, I will overlap what Dennis said. And if we go through 4 steps of like big data, first is setting agenda. And first here, the risk is not to jump into over-regulating and be open and learn and make the priorities in policy setting. Then the second stage is coming to decide about access to information. And here, as Musa said, it's what kind of information we should have access to, where this information should be stored, and who should be in charge or owning that information. Here are a lot of challenges. One, we have over-regulation of those information because currently in most countries these privacy data are out there, so no companies can share the information officially, like legally. But the data are scattered very much, and there is a need for cooperation, intergovernment, interministerial one, between private sector and government, and sometimes for cross-border transactions, it will bring more challenges on international area as well. So here is the challenge of cooperation is there. Then it comes analysis. Here, for regulators, policymakers, we need to build capacities. It's not that easy to do, even if you have that data, it's not that easy to analyze them. The tools are just emerging, and to have the wrong psychometric of the person is very something that can happen and can bring more challenges. Then analysis, and regulators are in a position of with low, very low capacities here. And then making policy decisions that first build the trust of consumers in the use of the product and help FSP, financial service providers, to bring better suited products with better channels to more consumers overall. So this is kind of policy, could be purpose or ultimate goal for policy in data, big data regulation.
Thank you. Sue, your last word?
Yes, I would have to agree that it's about monitoring and analysing, but I think there are two quite distinct things here. One is data protection and data security, personal data. So, but that's generic. That's not necessarily about financial services. That could apply across a lot of markets. So if you don't have that kind of law, it's worth thinking about that probably first. And then the question is, well, what is happening in financial services markets that actually is unique, a unique issue to do with big data and the way big data is used? And I think then you might get into some conduct issues about the way big data is used, possibly to discriminate, possibly to exclude others. So I think there are some conduct issues there that may well be secondary depending on your state of data protection law, but they're still nonetheless important. And my one sentence would be, please don't forget those who will be left behind.
Paul, last thought.
Great, yeah. So a few ideas. I think that this is still very early.
30 seconds.
Okay, this will be extended big data 30 seconds. But they're still very early in understanding how big data is going to work. I would encourage you to learn what's happening in your markets. Let's build the data set to understand how this actually impacts customers. Very little third-party research has been done to understand the benefits in terms of increased acceptance rates, lower prices, better quality, but that is something we should study and learn, certainly before we jump to any particular regulations, so that while we safely do this, we also can protect the potential benefits of this. And the last thought, which is a repeat thought, is the more we can empower customers to own, control, and decide who gets to use their data and for what purposes, the better. We currently have very much a gatekeeper regime on a lot of the most valuable data out there. It is not technologically that difficult to create an ability for customers to organize and centralize a lot of this data. It is mostly a business model and just a market participant challenge. I think that is something you can really help with, and then I think a lot of the concerns don't go away, but they can be mitigated if the customer knows what's happening and is choosing to give their data away, making the privacy trade, so to speak. So I'd urge you to consider that. That was probably 1 minute, sorry.
Yeah, it was a little more than 30 seconds. Can we have the final voting questions, please? It's just to leave you. All right, you get to only choose one statement. Listening to all this, what do you most agree with? The potential financial inclusion benefits far outweigh the risks. Option 1. Option 2, while low-income financial consumers will not be very worried about loss of privacy, we do need to do something to strengthen data security. Missing word, security there. Number 3, it's essential that financial regulators and others act soon to safeguard both the confidentiality and the safety of consumers' data. And number 4 is basically, you know, we have things in place, and that's enough. Beyond that, financial sector regulators don't really need to act. So let's get to 50 votes. I think some of the words were not exactly translated. I hope you get the gist of the statements. All right. So a third of you are pretty sanguine. There's a lot of So may I just observe then, in closing, that this seems to be a topic where there's a lot of interest and probably a wide variety of views around the room. And so a question as an external partner that I would put to Afi is, where do you want to go with this topic? Where does it fit in your working group structure? Is it something that maybe needs to be a joint investigation across multiple working groups? Do we want to look into the Madrid Protocol and other arrangements, regulatory and legal arrangements that are in place on the ground? But from what we've heard, I'm very confident we have only really scratched the surface on this topic. Let me thank all of you for your interest and participation. Let's thank our panelists. And thank you very much to Afi for the opportunity to kind of bring this topic here in this way. Thanks a lot.